corporate earnings have been on fire so far this year, but according to the Wall Street Journal, many analysts say earnings may have peaked in the first quarter when they jumped 25% from a year ago. Joining me now, Joseph Sroka, Chief Investment Officer at NovaPoint Capital, and Art Hogan, Chief Market Strategist at B. Riley FBR. Art, I'll start with you. You know, we talk about peak EPS, but when you look at the balance of the year and consensus estimates, we're looking at 19% for the second quarter, 21% for the third, 17% for the fourth. And in fact, I guess all this worry comes about because of years like 99 and 2006. When EPS contractions actually had a pretty horrific impact on the markets. Art, what do you say? Is this going to happen again? Will we have a major sell-off in U.S. markets because of earnings?
No, I certainly don't think earnings are going to be the cause of a sell-off. And when you think about it, so we had a 25% first quarter earnings for the S&P 500. We were expecting 16% coming in. So when you think about the lineup of expectations, which are always low, we're probably going to be fine in 18. We will have a fall-off in earnings in 2019 as we anniversary lower tax cuts. But I still think we're going to have sort of low double-digit earnings growth. It's much more important, Jerry, to keep an eye on revenue. We've had significant revenue growth in the first quarter. It looks like the same thing in the second quarter. I think that's not going to be the driver.
Yeah, I think analysts really like to look at that top-line number, that's for sure. But, Joe, you look at this, the S&P has gone 97 trading days without hitting a new all-time high, and this is kind of a metric that people are paying a lot of attention to. Do you expect the broader markets to react to this declining, this pressure on earnings?
It's not pressure on earnings. It's a deceleration in earnings, and a lot of that is driven by the fact that we're not going to have a new tax cut for 2019. Half of the earnings growth this year is a direct impact from the tax cut. So earnings will still be up next year. They're just going to decelerate because they're not going to have that tax cut catalyst behind them.
You know, I'm sitting here thinking, Art, where else are the investors going to go, right? I mean, European growth is slowing. Art, what do you see? I mean, is there another market to get into here?
Yeah, it's interesting, Jerry. You know, that question was probably better asked last year when we didn't have a certain amount of strength in the U.S. dollar. I think that, as the dollar strengthens, that makes it more difficult to make investment decisions in emerging markets. And certainly a bit of a springtime slowdown in the Eurozone. And that's complicated by things like an Italian election, which we really don't know what the offshoot of that's going to be with Brexit coming up. So, yeah, to your point, I think it's really a U.S. market. But within the U.S. market, making sure you're selective about what market capitalization. We like small and mid more than large.
And there they are right there.
We like technology.
Looking at a chart of the Russell 2000 and how that index has performed, which is incredible. Joe, to you, there are lots of other things to be worried about besides what appear to be declining earnings, and that's interest rates. The Fed just saying last week that they're going to pick up the pace of rising rates. And, of course, we've got this big trade war going on. What do you think the market's going to be focused on? Is it earnings or something else entirely?
I mean, right now it's trade. There's always going to be a risk-on, a risk-off catalyst in the market, and right now it's trade. You saw we sold off end of last week. Futures are down this morning because how the U.S.-China trade situation works out right now is an unknown. And then I think once we finish off the second quarter and get into earnings season, later in the summer, then the focus will come back to earnings.
All right, so much to talk about. Joseph Menard, thanks for coming on today. Great job, guys.
Thank you.